All right. Good afternoon, everyone. I hope everybody's having a fantastic afternoon. We are going to get started in about 30 seconds. I'm going to give everybody a little bit more of an opportunity to join in case someone's stuck on a call or we're just a little tied up. So really excited about today. Really excited that we're going to have some good conversations surrounding life insurance, as all of our meetings are typically. I really want everybody to engage, ask in questions. Know that there is no stupid question unless you don't ask it. Today is going to be just to kind of manage your expectations, is that it is going to be very basic today. So the conversation piece is basic. We're going over the very basic fundamentals of life insurance. Now, I have made a commitment to both Carrie Levinson and our life insurance partners that we are going to write a whole boatload of life insurance. And because of that, what we wanted to do is we wanted to get everybody started from a single foundation and making sure that we're all starting from the same place out of the gates. And then as we start out of these gates and we get rolling, we can enhance the process with more carrier-specific training as you guys need it. But a lot of us have been really engaged in life insurance for years, and it's really to get everybody up to speed. Now, when we talk about life insurance, what we really want to talk about is the opportunities that are there for everyone, because we're just missing these opportunities because we're not talking about it. We're not comfortable about it. So what I've done is I've put together today's training. I've also put a handout together, which you guys can find inside the drive. You'll see it here. You can go through and you can look along with this as we're going through our presentation today. And then we'll pause from time to time, as we always do, for some questions. And I'll probably answer them as we're going throughout the presentation. So with that being said, let's get started. So really, as I said, just to recap for those that are just joined, this is our 101 training, the foundational training that you're going to see here for life insurance. So one of the tones that you're going to have to really think about is that there is no urgency for life insurance until you start to build it. This is not a transactional sale. This is a follow-up with me, harassing kind of thing, when I mean that in the loosest terms possible, but planting the seeds throughout the conversation and making sure you understand the need, identify the need for life insurance, and then do appropriate follow-up. You know, no one is just going to be calling in and saying, oh, by the way, I need life insurance unless they're sick, and then that's going to bring up a whole nother set of conversation pieces as we get through our presentation today. So think about it. You're never going to be as young as you are today or as healthy as you are today. It's going to be more expensive every single day that we go down the path. Every day that goes along, we're going to get a little bit older. We have a little bit more propensity, or what they call morbidity, the ability to die, and those statistics start getting higher and higher as time goes on. And that's something that you need to think about when you're talking to your customers. So today what we're going to do is we're going to talk about the different types of life insurances. We're going to touch mainly on the ones that we're focused on. What's the differences in these types of life insurances? When we're talking about important terms that you need to know for the sales process, as well as how to identify the need of your clients and prospects, because we really want to start with you calling your current book of business if you want to be successful in this. How do you choose the type of life insurance that a prospect needs? How do we identify that? We're going to run through the Carrie Levinson site. I want to show you some really nifty tools that they've got there. And then we're going to talk about transitions into the sales process as well as the rebuttals, all of the things that people are going to tell you. Again, it's the basics: no time, no money, no need. Ooh, shocker. No one ever comes up with anything new for us. So as we start talking about the different types of insurance. Those of you that have printed out already the different types of insurance, we're going to cover only a small portion of them. But as you look through this, I've kind of gone through a couple of Department of Insurance websites and some things that we know about, and we've put together all of the different types of insurances that are listed here. And there's flexibility in those types of insurances, so you can follow along with that. We're only going to cover a small portion of those simply because when you get into all of these different types of policies and annual renewable term and credit style policies and decreasing term, they're all kind of hybrids of other policies. For our conversation today, what you really need to understand is that there are a couple of key factors. There's term insurance, there's whole life insurance, and then there are variable or blended products, which is some combination of those two. There are some other things they call juvenile, and look through your sheet, but we're not going to talk about those because these are the main or the crux of all of the life insurance policies that you're going to have access to, or that really important for conversations when you're talking to people. So get comfortable with these words as we start looking at it, because this is where things are going to start to kind of open up. And as some of you that have never sold life insurance in any way, shape, or form, please perk up any questions. Universal life is a blended policy. Okay, variable life is a blended policy. That means that there is a term life component and an investment component, and we'll get to that, some of those questions that are coming in as we get through the presentation. So the core types of insurance, term insurance, whole life insurance, and those are really the two core, right? And all of the other products are kind of subsets or some combination of an investment piece and a life insurance piece blended together. And the best way that I like to explain term insurance, and when I started in the business, I started with life insurance and, Northwestern Mutual, great training program, all of that good mumbo jumbo. And a really good trainer explained it to me probably the best way, and it's like renting a house. And the way that you have to think about it is that you are renting that life insurance. And as you get that life insurance, as a term policy, it allows you to rent that house on the beach. Where I surely couldn't buy the house on the beach, I wouldn't be able to be on A1A in my, $3 million house. I would be able to stay there maybe for a weekend or two, but I wouldn't be able to own that house. With a term insurance policy, I'm able to get a higher death benefit because it's for a period certain. And with that period certain, Chris, what it does, it allows you to stay in that house or to stay in that policy at a higher value because you wouldn't normally be able to afford a permanent insurance policy. So what the definition of term is, very basic. It's a life insurance policy providing you coverage for a certain period of time. That is the term. If you die during that term, everything is beautiful. Your beneficiary will get paid. Now, we do have caveats to that where we're going to talk about riders, and some of those riders are shown here inside the document that I've put together for you guys that you can reference. And those riders can be return of premium, accelerated death benefits, and a whole slew of different riders that can enhance a term life policy. Now, most common when we see terms, you're just getting a solve for a period certain. So I have my house mortgage. My house is going to be, up for grabs for the next 30 years. I'm going to have to be making my payments. So I want to make sure I have a term policy that's good. I have a $500,000 house. So I need to make sure that I have that paid over the next 30 years. If anything should happen to me, we want to cover that. Some people argue, well, it's less expensive. You could do a decreasing term. But in the event that you pass, it's a good and easy way for you to pick a dollar amount. As we start talking about identifying needs, that'll become a lot clearer. Annual renewable term, that's very popular. You get it with your credit card company, sometimes where you're working, and that's something that every year it renews. So it's typically very inexpensive because the insurance company is making a bet that you're only going to die in that year, typically, and it just renews every year. With term policies, straight term policies, not a blended policy, there is no cash value typically. Now, when you're dealing with that, it's, if you have a return of premium rider on there, and just so everybody knows, there are certain companies that will offer return of premium riders. And then in that scenario, what would happen is I would pay my premiums that if I didn't die in 30 years, at the end of 30 years, they'll give me back a portion of my premiums. Typically, they give you back all the premiums without the cost of the rider attached to it or some combination. And that's, of course, a carrier-specific rule, and you'll have to look at carrier addendums to make sure that you're talking about that correctly. Term insurance, very popular. The old adage of, buy term insurance and then invest the difference as we start talking about whole life. But really, the key factor I think everybody needs to understand is you can get a value of life insurance that most people say, I want whole life, because that's what everybody hears, but they can't afford a $250,000 whole life policy. And not always is that necessary, depending on what we call the solve. So is everybody comfortable and understand the difference between renting a house and owning a house? That's going to be the difference between the whole life and the term. I think the renting the house is really a good way to understand it, because again, I can get that $1 million, $2 million house on the beach if I need it. And that could also be currently I'm renting an apartment and I'm making $25,000 a year. I need $100,000 worth of coverage. Well, I can get you that nice house that you're going to get into under a term policy. If nobody understands that or we have a problem, just let me know and I'll go back to it. So why do we buy term insurance? Term insurance is going to fit the need for a specific time frame. Term insurance is more affordable and can serve a specific need that everybody has that's out there from a financial standpoint. Everybody wants whole life insurance, and we understand that, or they want a UL or they want an IUL. We'll talk about those blended policies, but the cost is sometimes prohibitive for that. And there are cases where, just a term policy will be perfect. For example, I'm worried about my son going to college. So I've got certain amount of savings. So with that, I know that he's going to be going to college in the next 10 years. He's 10 years old. So as long as I have an extra $150,000 or $200,000 to cover that by the time he gets to school, then his college funding is done if I should kick the bucket. No big deal. Again, I mentioned mortgage protection, debt payoff, income replacement is a big thing. We need to replace an income, and we'll talk more about that when we get to the needs screen. Child support funding, making sure that your your child, your family is taken care of, making sure that your current child is taken care of. I mean, I could pose the question here. I'm looking at some of the names that are on here. I know many of you, as I look at the names, have babies on the way. I know some of you have children. Have you ever assessed your life insurance, and do you have enough to take care of your children when you die? Because you're going to die. It's going to happen. It's just a matter of when. Business partnership protection, those of you that are, working in the group space, that's where we do buy-sell agreements and different things like that. That way, your business partnership, you may not have to go into business with your partner's spouse. And that happens quite often. In the event that I have a partnership with someone, me and him get along great, he dies. Remember, this is all when someone dies. Do I want to go into business with the spouse, or is there a death benefit built in, and there's a death benefit there that could therefore buy out that level of partnership, the value of half of the business in that case, and then I don't have to go into business with the spouse at that point. Charitable giving, also, those of you, charitable giving is also a big thing as well. If you're going to be want to leave things to the church, also very popular for life insurance, depending on demographics and who we're talking about. And one of the big things as well is we're going to talk to a lot of people that are going to say they don't love anyone. Well, what happens if you have pets? There's some of us in the office that have birds that are going to outlive us, right? So who's going to take care of those pets? You can leave that to an estate, and then those pets can be well taken care of. Term insurance, very basic. It's simple, right? It's you die during this period of time, your beneficiary gets money. We could add riders to enhance that, and it's going to serve a particular need for a period certain. Well, now we have whole life insurance. So whole life insurance is like buying the house. So now I may not be able to afford the house on the beach. I got to go a little closer to Route 95. I'm not going to be on the Gulf. I'm not going to be, by the Sand Pearl. I'm going to be on the other side of the bridge. I may not be able to buy the house that I exactly want in a whole life policy, but you own it, okay? It's yours. It builds cash value, just like that house on the beach is not losing money, right? I'm not just throwing that money away in a rental fee. I'm building value. That beachfront property is going to continue to gain value. That value that it's gaining is the cash value. Now, that cash value increases on a whole life policy as we get older because there is an investment piece there. There is a guarantee typically on this accumulated cash value, and that value will build and will build. Depending on how the policies is structured, the death benefit may continue to increase. The cash value will stay in the policy. Now, there's lots of different ways that you can build these whole life policies, paid to term specific, in other words, like a paid to 65 policy. You can have a policy that's paid to age 100, all different ways of designing that. But the whole life policy builds cash value. You can borrow against that or withdraw against the cash value. There's typically no penalty. Don't have to pay it back depending on how the policy is structured, but it would effectively change the death benefit on the policy. There are loans that are on that you can do. Some are interest sensitive, some are not. Most common whole life policy that we're going to be talking about is going to be final expense. And in this day and age, a lot of the whole life policies that are out there are very good, but the blended policies from that type, IULs and VULs, have kind of taken a stand in the way that you can fund them, in the way that you can overfund them. So the whole life, or a typical traditional whole life policy, is very good, but it does really affect the final expense piece. So we are really going to be talking about the final expense. These complicated policies, as we just get started, is not an insurance 101 conversation. So we have premiums paid forever in some cases, if those of you that have done quotes, and you've seen those as well, and then hybrid policies, which a whole life policy is part of a hybrid or blended policy when we're talking about IULs, universal life policies. And you can see that because in a universal life policy, what's happening is you have a term portion of the policy and you also have a permanent portion of the policy. Now, on that permanent portion of the policy, that's building some cash value. But if you go with a policy that is going to give you stable premiums over time, what's happening is you are eating away the cash value in a blended policy to keep the premiums consistent and level. So if, for example, I have a policy that is level premiums to age 100, when they're anticipating what those level premiums are going to look like, they are assuming your premium payments, and if you haven't dumped an extra money into the policy, then in that scenario, as you're going through it, at a certain age, your premiums are not going to be enough for the death benefit. And every single month, it's going to take away from that cash value to make up with your monthly level premiums. And that's no problem, but that's why they're level. I could also stop paying for my policy in that situation. And if I stop paying, I will dwindle down the death benefit to a point where there is no value, perhaps, depending on how much money I've paid into it, how many years, compounding interest factors, guaranteed factors, and several other things that play into it. But for the basis, why do you buy whole life? You want something more permanent. You're buying the house. It's yours. You can keep that house. It's going to build that cash value. I can access that cash value for other things that may come up when life hands me a bad barrel of pickles, so to speak. Okay? I can borrow against it to use it for other purposes. Now, don't be fooled. You can't call it an investment, okay, because we all don't have our Series 6. And even though there is investment portions to it, it's not really an investment. Because there's guaranteed levels in it, because it is building cash value, it has flexibility, but don't call it an investment. So you would use these for the same types of purposes that you would use a term policy for, but knowing that this is going to be a little bit more long-term. And again, typically we're looking at estate taxes, final burial expenses, making sure that we have all of those things covered. Business partnership protection and business protection, it also plays into this. But again, you have to look at, does the juice equal the squeeze? Is the purpose of having this policy for a lifelong benefit worth the extra money that is going to cost? And it is not inexpensive for a good policy. It is something that is going to be much more out-of-pocket expensive than a term policy. And you can demonstrate that to folks as you're talking to it. But what we want to remember for today and for all of our conversations as we talk about life, no one on this call is selling a large amount of life insurance now. Don't get caught going down the rabbit hole with complicated policies and 8,000 calls to Carrie Levinson. And we're going to talk a little bit about that as we get further in the presentation. Let's KISS. Keep it simple, silly. Little change there. So a good whole life policy, as we look at it, it's going to protect the principal that the customer is paying into the policy. It's going to have some sort of guaranteed growth of money. Dividends that are paid to the policyholder can be reinvested into the policy to therefore increase the face value or add to the cash value. Therefore, compounding interest is going to help significantly. You have access to the cash value at any age. Death benefit is going to grow with the cash value. Again, for our conversations, we are going to spend more time on final expense whole life policies than we are with our traditional whole life. So blended policies are exactly that. They're blended term and whole life or investment style portions of policies with a guaranteed death benefit that has cash value building in it. But unless these plans are designed properly, you could be screwing someone. One of the big things that you have to make sure when you start entering into a life insurance conversation that you have a fiduciary responsibility to speak with your customers, to talk with them and make sure that they understand what's going to happen. So let me give you a little life lesson here. When my father bought a life insurance policy, he bought a policy that he thought was going to last him forever. When the agent sold him his policy, happened to be one of his friends, he didn't disclose that that policy was not a forever style policy. And it would have been appropriate for him to have a forever style policy because when he reached 67 years old and his level premiums ran out, his policy that was affordable went from $300 a month to $2,200 a month for the same death benefit. So ouch, because at the time he had been diagnosed with end-stage renal disease. If he had exercised his convertibility options, if he had, properly discussed with the agent of his plans of maybe he should have something, a smaller death benefit that would last him forever and a term policy or some combination of that, would have been better planning. Another example is a gentleman who, it's a family friend. He has when he got married, he bought a 15-year, why, I have no idea. A young guy bought a 15-year policy, and now his 15-year policy is running out. Well, unfortunately, it does have no convertibility options, and his 15-year policy is going from $60 a year to $700. And now, unfortunately, he is uninsurable due to his health class. So managing the expectations of your customer, I'm not trying to make this too complicated, but you need to understand the real world. The real world is that a term policy is going to fit the need for something specific, and something more permanent to your whole life or blended that gets someone to an age 100 is a great combination of the two, because in that scenario, you're covering all of the needs of the customer. In a blended policy, some of these are tied back to the stock market. So with these policies, the investment portions, you have some flexibility. They can be tied to all different kinds of things, but it is mostly the ratcheted style effect, meaning that the customer can go up and gain better returns. Typically, they don't lose money. However, what you must understand with a blended policy, that if you don't design it correctly, the cash value will be absorbed by the cost of the life insurance as a member gets older. So, for example, if David bought a policy and he buys that policy today and it's a paid to age 100, he dumps in a little extra money now, but as he gets older, he understands that those level premiums that he's looking for, that's going to give him a certain death benefit. He's not going to have cash value in that policy to access as he gets older in most cases, because When he's in his, 70s or 80s, the cost of the insurance portion is absorbing the cash value in a lot of those blended policies unless they're designed properly. And I always keep on saying that because you have flexibility in the design of premium dollar amounts, how much money you're dumping into those policies. We do have to be careful about things called MECs, which we'll cover a little bit later on, but that's when we get into more complicated policies. But for today's purposes and a foundation, what you have to make sure is that we design it correctly, we purchase the right policy, and we build it. They will come. Okay, so here's the real 101 kind of stuff that we need to understand, because a lot of you that have never said the word life insurance outside of studying for your test, you need to understand a couple of terms. Now, I've put a full glossary of terms in the document that I've sent over to you guys. So you will be able to take a look through all the different kinds of riders that we're going to have. Oh, did I not put the glossary? I got the glossary in here. I think so. If not, I'll get it in there because I already have it. So in talking to some of the carriers, what I did was I proposed a few questions, not proposed. I didn't propose to the carrier. No, that's not happening. And what I asked them is to give me your top 10 or 15 things that your agents are screwing up on their applications. So they sent me a list and I nearly threw up because I could not believe that agents that have a health and life license, so that's everybody on this call, would have these mistakes being made. So let's review the basic, because I'm not going to tell you which ones, but these are some of them. Death benefit or face amount, that's the amount of money that the named beneficiary will receive in the event that the insured dies. Now, when we're talking about beneficiary, remember, we'll get to it, but it can be an entity. It doesn't have to always be a person. Term length, that's the length of the time, typically in years, that the policy has a guaranteed rate. And after this term, most policies are renewable on a guaranteed basis, but the rate is not. That's my father's example. He was sick. He was able to keep the policy. He could keep it for the life if he could afford it. So that's one of the big things, because with that, you have to understand that you may be guaranteed renewable, but what the hell is the rate going to look like? Unaffordable. Policy owner must have a financial interest, and this is the person that owns the policy. The policy owner, and on the next line you see proposed insured, can be two different people. So in other words, I could buy a policy be the owner of a policy that is insured with Crystal, for example, because if something happened to her, I could own the policy, I could buy the policy. I could also be the beneficiary because there has to be a financial interest there. So if a spouse is buying a policy for the other spouse, one could be the owner of all the policies, and then the proposed insured can be different people, but there has to be a financial interest. Typically, the proposed insured and the policy owner are the same person, unless we're talking about a family dynamic or we're talking about a business situation, and that could be flexible on those. But you do have to understand that those are two different things. And when you're taking an application, if you're taking the application from the policy owner, the questions must be directed to the proposed insured. Because if the policy owner dies, that has nothing to do with the proposed insured. Remember, the insured is the one that we're doing underwriting on. Beneficiary is the person or entity that gets paid if the insured dies. Contingent beneficiary, in the event that the primary beneficiary is dead, the death benefit has to be paid to another person or entity, and that's a contingent beneficiary. And you could also have an estate for either one of these. But if you're listing an estate, then your insured must understand that, that beneficiary, that whole process, that estate must be set up. You can't pay an estate that doesn't exist, or you can, but then it gets really complicated, and that's a whole nother conversation. Accelerated death benefit. This is important, and this is basically a critical illness piece that's built into your life insurance policy. This is typically a rider, and in the event that the proposed gets diagnosed with a terminal illness, a portion of the policy may be paid out. So I get diagnosed with cancer, I'm terminal, I'm going to die in 3 months. I've got $1 million worth of the policy. I can have $750,000 now, and I can go do whatever I want with it. That's typically a rider that we would add to a policy. Convertibility. With term policies, there is typically a portion of time that you can create, and you could transfer a portion of the policy from term to whole life. And this is typically without medical questions. But it can only be done during certain periods. And as you look at the policy itself, and as you're looking at the plan and what you're looking at, you can check convertibility options. Replacement. When a proposed wants to replace one in-force policy with a new one. Typically not a good idea. There's not usually a whole hell of a lot of reasons. You can add to a policy, but you normally don't want to replace that policy. Because remember what I said in the beginning, you're never going to be as young or as healthy as you are today. Now, if I purchased the policy, for example, when this might be applicable, if I purchased the policy and I was higher risk at that time, or I was a smoker, I had a different health class, and they're not willing, my original policy that's in force is not willing to re-rate the policy, then you may be able to replace it. You do need to be conscious that replacing a policy is not always allowed with certain carriers. What you also have to understand is what are they giving up on that replacement? Is there cash value? What is the age that they've given up, and is that make a lot of sense? Did they get bamboozled with the first policy, and that's why you're replacing it? If you do a replacement in that scenario, be prepared for additional documentations that you need to do. Underwriting, we don't have a lot of that in the health space any longer, but underwriting is underwriting. They are going to determine what rate class they are and what premium they are going to get charged. When you are estimating or you're quoting someone, you are estimating that premium amount, so it could change because the risk or rate class could change as well. So, for example, if my member tells me they are healthy as a horse, they are a past Olympian, and then it turns out that they're not. They're taking 16 medications. They've had 4 DUIs and a partridge in a pear tree. Well, in that situation, they may not get the quoted rate class. And when we start talking about quotes, we will discuss appropriately addressing underwriting questions. I'll show you where to find a lot of that, so that way you do not overpromise and underdeliver. Always better for you to quote a higher rate class or a more expensive rate class than telling everyone they're going to be an Olympian and turn out they're not. So before I get to determining the need, I want to pause really quick for any questions that may come up. So this is where the rubber hits the road. Any questions? Now, I know some of you have sold a lot of life insurance, so I do apologize for the fundamental foundation of what we're going through today, but hopefully this gives everybody a good thing for us to build off of. So how do we determine the need? So the need is really the big deal, right? But you're going to have, and this is something for years I've been calling a courageous conversation. And the courageous conversation that you have to have with your customers that they are going to die. We had an agent that worked for us for a while, and he would sit out on the floor, and I'd hear him on the phone all the time. And he goes, "You are going to die." Nice Spanish guy, but that was it. That was his pitch. It didn't really work too well for him, but it wasn't as courageous as I really wanted it to be. So when I say that, it's just having a conversation with someone that they don't want to have, okay? No one wants to understand that they are going to die. No one wants to really take hold of that understanding and admit their mortality and their morbidity. They could get sick, they could die. So when we're looking at this and we start talking to these people and we ask them about what are their plans, right? And we need to have this conversation and talk to them about their life goals for their family. And we want to protect your finances, the financial well-being, the financial wealth of your family, because there is a piece there now. We need to talk to them about their mortgage needs and what needs to be paid on their mortgage. And, I don't want to leave out, and I talk about this in a couple of slides in the future, about rentals. So we're dealing with a different customer now, right? We're dealing with highly subsidized individuals. So in the event that a highly subsidized individual loses their income, they die, they're losing that particular income, they may lose their home. And I don't mean like the bank's going to come and take it. They may have no place to stay. You can't pay your rent. So replace the rent and mortgage in that sentence. Who's going to pay the rent? Where are they going to really, where are they going to live? Do you have plans for your kids to go to college? And is it funded today? Because if it's not, and that's everything is in today, because we don't know what's going to happen tomorrow. I could get hit by a bus tomorrow. And if that's the case, what is the plan for my son to go to college? I have some funding plan, but I don't have it all planned. Remember, if you died tomorrow, what's the plan for your final expenses? And that final expense is not just putting you in the ground or burning you or doing whatever you want to do when you pine box, non-pine box, beautiful, elaborate stone, mausoleum, whatever it is. We also have debt that's going to pay off, because most people are not going to have zero debt by the time they stop working. And it doesn't really happen. We have estate taxes that you have to worry about if you have an estate. Now, those of you that don't understand what that is, we'll cover that more. But remember, when you die, if there are monies that are transitioned, there's property that's transitioned, there's taxes that need to be paid on that transition. Are you going to burden your family with that debt as well? How about the ability to allow your family to grieve without a financial burden? Use my father as an example. If I was not there for my mother, thank God, knock on wood, I'm very blessed to be in a position where I was at the time, that I was able to help mom get her stuff together, because otherwise she would have had nothing. I mean, the whopping $250 that she got from Medicare, woohoo, real, that's great. But how would she take time if we were a working family? If it was my spouse and my child, don't you want to grieve? You're going to need to take some time off. You have children. Who's going to spend time with those children, making sure they understand what's happened to their family? Or is mom going to have to run right back out and get a job that she didn't have now? Or how is that going to happen? So financial burden if you die, and how your income will be replaced should you die, all very important pieces. So when we determine the need, I've actually got a couple of pieces here, and we're going to show you the lifehappens.org website. Also, inside the 101 training, I've put a little document that this is something that you can kind of do on your desk. You can print this up, kind of gives you a guideline, because what we want to do when we're talking to a customer is we're going to engage. And we're not talking about the engagement of the words right now. It's, we're talking about getting someone talking about life insurance, making sure that you have enough to be dangerous, making sure that you've got a pathway to go down. And this sheet will help you kind of assess those questions and assess what you need to talk about. So this is a pretty simple form that I put together, and it kind of gives you that guideline. So what you see here is on the lifehappens.org website, there is basically this form that does it automatically. You enter in the numbers, and then it spits out a need at the end. For our demonstration today, I just want to go through the questions so that way we understand it. And this is something that I think, if you examine your own life, give you an idea of what you should have and what you don't have, I guess. So first thing, we want to look at what is your family's annual income if you died today. So total annual income of your family would you need if you died today. So typically, if I'm the only breadwinner in the family, that's something that we need to talk about. You write that number in there. It's typically 65 to 70% of your income, just like a disability policy. Annual income your family would receive from any other sources: spouse's income, fixed pension, not income from assets, because we're going to add that a little bit later, but give you an idea. So if I'm making, $50,000 a year and there's no other income coming in, or I'm making $12,000 a year, if we're talking about our highly subsidized individuals, this is still the same conversation, just the numbers just change. And math does not lie. So if you subtract those two lines, everybody's got a calculator, you just subtract the line 1 and 2, make it really simple for yourself. And then you want to have capital, you need to have income, multiply line 3 times the table below. So that gives you an idea, how many years do I want to replace the income for my family? So if I died tomorrow, and I needed to make sure that, my family still could pay their bills, just replacing my income, not talking about expenses, what would that number look like? That's going to give us an idea just on replacing income. And a little bit later, when we get into some more slides, this will make a little bit more sense for some of you, just in case any of your heads are spinning. Next thing we need to talk about is expenses. Outstanding debt, funeral, final expenses, capital needed for college. These are probably the 3 biggest expenses that could really rear their head in the event that I go away forever. So final expenses, what does it cost to get buried these days? Well, that and also in addition, the estate taxes. You could use 2 different numbers, greater than 15,000 or 4%. Some people are going to say, well, listen, it's not going to cost that much to put me in the ground. You would be shocked on how much those things cost these days. And remember, we have to take into account inflation, because the $15,000 today does not look like $15,000 did 30 years ago. And 30 years ago, I think that $15,000 would have been a lot more valuable than it is today. And I don't think anybody would disagree with me on that. Paying off the mortgage, other debts, credit cards, car loans. Now, the capital needed for college gets a little bit complicated, but I want to make sure that we understand it, because you could simplify this. This is an actual formula that comes from statistical data. And what this does is this shows you the estimated cost of a private school or a public school and your children and how long do they have before college. So what you could do is you can fill this out. So I have a kid, he's going to go to private school. I type in 163,000 here, for example. And let's say he's 10 now. So he's going to go to college in 10 years. I'd multiply that number times 0.91. So it goes down a little bit, right? And then it gives me a number. So if I've got 3 kids, 4 kids, 5 kids, 10 kids, whatever it may be, you're going to add that up, and then you're going to put that capital needed for college here. So we're going to add up 5, 6, and 7. That's going to give us a number. There we go. A little scary. And it's meant to be scary, because if you're engaging in a conversation with someone, how did you pick the number? I've got $100,000 worth of life insurance. It's going to be what's going to happen, right? I get Jimmy Bob on the phone. Jimmy Bob says to me, I've got $100,000 worth of coverage. I got plenty. How'd you pick that number, sir? So when you look at that, how did you pick the number? That's an engaging question. I just picked the number. Is it enough? What are you going to use it for? This is where a courageous conversation is much better than somebody who is just selling $30,000, $40,000, $50,000 policies, and we're going to talk about that. So let's talk about savings, retirement, current life insurance. This is the minuses. So I'm going to subtract those numbers from my need, which was above. That's going to give me a total life insurance needed. That's just going to give me a dollar amount. And then we're going to talk about how and what we're going to do with that dollar amount. So this needs assessment that you see here, this is actually giving you the same kind of thing. It's just calculating it for you. So you guys can go take a look at that later or look at this form. This form will help you do it manually and kind of go from there. So it's going to give you a giant number. So let's say that number is $500,000. Let's say that number is $1.2 million. It could be any number, right? The well-to-do customers could be $4, $5, $6, $10 million. But we don't want to scare anybody away. We have to start somewhere. Okay? So what we're going to do is we're going to start with an amount that's going to protect you now. It's going to start now because there is no time to wait. This is where the urgency comes in. This is when you put on your little sales hat and you know that you're not an order taker because no one wants to admit that they're going to die, and they are going to. If they haven't taken care of this now, if they have been thinking about it, but they keep on putting it off, you're never going to be as healthy as you are today or as young as you are today. What happens if they come out and do the paramed and there's a problem? So we're going to talk about that. So we want to start simple. We want to start with a simple term policy. We want to satisfy a particular need. And when we're doing that, life gets in the way. If I do a policy for Matt and, we're talking about it, he's got his family he's starting to, all of these things are happening, but, he's got to take time out. He's going here, he's going there, he's running around. He forgets all about the life insurance. We want something simple. We want something affordable. And typically we're going to look at the simplified issue policies because people aren't going to do the paramed. I don't know if Preston's on the call today. We've had multiple conversations about that, and Scott Webb, and we've gone through it. And you write a whole bunch of policies. You think all this money is coming in. Oh my God, this is fantastic! I protected all these people. Turns out none of them answer the phone. They're dust bunnying the paramedical people. Nobody can get a blood work done. They're not getting medical record. They're not doing what they need to. You did the front end, but the front end is the easy part. Following up and making sure they do everything else. So what we want to do is we want to start simple. So how do we get them to tell you what's most important? Well, one of the ways that I like to do it was successful for me is asking people what would keep them up at night. If I was going to tell you were going to die tomorrow, what is the biggest concern that you would have for your family? And that is a real thinker question, right? It's going to be like, it's going to make the conversation a little tense and a little quiet. But if you said to someone, listen, you've got 3 kids. I get it. I understand. Yep. Times are tough. Money's tight. All of it. Listen, let me just ask you a question. There's lots of stuff that keep people up at night. I have a real hard time sleeping, especially around open enrollment. But let me ask you this. If you were to die tomorrow, what would be the biggest concern in taking care of your family? And let's solve one of them. Is it replacing your income? Great. You make $25,000 a year. You want to make sure that your family has 10 years worth of income. That's $250,000. Make it nice and simple at a zero. We start there. Is it your kids going to school? Do you just want to pay off your house so that way, okay, now that bill goes away, gets rid of all your debt? What worries you most? We're not going to do it all today, but I'm going to be your trusted advisor and I'm going to be here. So as we get to that conversation, now you've got a number. Now you've got a starting point, and that number should not be too big. It needs to be affordable. It needs to be comfortable. So now that we've got a number, let's talk a little bit about your health. Because field underwriting has such a high level of importance before you get the quote going. It's like I did a call the other day with one of you guys, and it was a call for health insurance. And this is a kind of a good understanding. We were on the phone for 25, 30 minutes before we even knew if I had an SEP. Same kind of thing here. I got to know that I'm putting you with the right company, because if you've got height and weight challenges, you are, too short for your weight kind of thing. If you're not within the parameters of the height and weight chart, it's not going to fly with certain carriers. Comorbidity factor. Does everybody know what comorbidity is? Michelle, I asked, does anybody know what it is? Comorbidity are multiple factors. Thanks for being honest, a couple of you guys. Okay. Those of you that are from underwriting days, you should definitely know this. High blood pressure, high cholesterol, and weight. Those are 3 factors that all kind of go together. Asthma and smoking. There you go. There's a bright one. I smoke and I've got asthma. Comorbidity, typically going to be an auto decline. So when certain conditions put together, they become comorbidity, and it's a problem. Uncontrolled conditions. I've got diabetes, but it's not controlled. That's a problem. Lifestyle choices, DUIs, multiple arrest records. Now, the reason why we have these conversations now is because it makes it easier for you to pick the right company. And I'll give you some guidance on how you get those questions. Also, one of the biggest things is not following doctor's orders. So how many of us know a mother, aunt, or uncle, or grandma who they're their own doctor? They're WebMD.com. Well, my doctor told me I need one pill a day, but I'm only going to take a half, right? Or, I just took myself off that medication. That would be non-compliance with doctor's orders, and typically that's an auto decline. So these are the types of things that we're going to have to get comfortable with in understanding underwriting. So now what I want to do is I want to pause for a moment, and I want to talk a little bit about underwriting understanding, and I want to talk about how you're going to get really good at this quickly. So how many of you call Carrie Levinson whenever you have any question whatsoever? Me, right? Oh, I'm not going to look anything up. I can't find anything. This website is all convoluted, and I can't find it. So here's the starting point. Remember, we want simplified issue products. We want to start with stuff that you know is going to get issued. So what do you want to look at? First of all, you want to know who is doing simplified products. Really, the main focus should be a surety. A surety is going to offer a non-med product up to $350,000, and we can look at those guidelines and understand them. But if you click on product guidelines, which is located in products, product guidelines, you're going to see it's going to open up the holy grail of information here. And any of you who are going to sell life insurance, you need to visit this area. You should not be calling Carrie Levinson for every time that you want to talk to someone about life insurance. So, for example, you can choose, look, there's 300, I don't know if you could see that, 331 documents. Here's the majority of all of the carriers that you could possibly want to work with, and we're going to keep it simple. So you have all of them here, and you could scroll down, and you could look at, there's just 4 pages of different carriers, and then even on all of these, you could see there's a little plus down the bottom, boom, and then it's going to open up all of their different products. Now, what this is going to do is this is going to give you those products, and it's going to give you all of the details. So, for example, I can click on the 20, and that's going to open up what are the billing, what are the billing options, these modal factors and all this other stuff. But all of this stuff is right at your fingertips. When you click on that, you'll see over on the left here, it talks about product features. We talk about descriptions and highlights, age limits. All of this stuff here is going to be brought up for you so that way you can kind of take a look at it. So bill charts is something that comes up often, and it's something that I mentioned before. Okay? And when we're talking about this is not a guaranteed issue plan. Okay? This is a non-med. So let's kind of touch on that because I'm getting a couple of questions. What's the difference between simplified issue and guaranteed issue? Guaranteed issue means that no matter what, the policy is getting issued, right? Simplified issue means that there's typically not going to be a paramedical exam. They're going to do the underwriting through telephone interviews and through the disclosures on the application, possibly medical records that are obtained from a doctor. But they're not going to do a paramed. We don't want to do paramed policies because their issue rate is so low. And you're all getting started on this, so you don't have an exposure to it. So follow my lead here. Start with the non-med policies and the simplified issue. So this chart that you see here shows you what all the max weight is based upon the height. You can be underweight and you could be overweight. So there are both aspects to that. And it tells you what rate class they're going to be. And you can see here based on age. So very simple to understand. We can see underwriting requirements here. And this is, some of you are asking as you're typing in questions, based upon the face value of the policy, what is going to have to be done. And you should be able to follow along with this. So this is a very simple way, and you could see, for example, if I wrote an surety policy, and you see a little A here, that means that I'm in Group A, non-medical. If I'm in Group B, so if I find a little B up in here, then I know I'm going to have a phone interview. If I'm C, phone interview, so on and so forth, to where if I get to, an F or an I, so like here's an I, right? So if I'm 18 to 35, I'm looking for $350,001. Then I'm going to have to, what's going to happen, it tells me right here, I'm going to need a blood profile, urine specimen, and a paramedical exam. Okay. Question, I don't understand. Explain the tables. This is very simple. Do you understand what I'm saying here? This is 101. So I'm making sure that you even knew that this document and this opportunity was here for you. So we talk about the underwriting details. We talk about them. This is going to bring all of this information up. So if you didn't know that this was here, that's why we're talking about it. Make sense? Okay. So this is going to go for all the carriers. You can search. This is all the carriers. You want to kind of stick with the surety. We've got great experience with them. Things have been going very well with them. We're issuing a good level of business. All of the things that you're going to need to be successful are here. Know that once you get to a paramed, you're looking at 1, 2, even 3 months out before that policy gets issued, and you're going to be chasing yourself. Now, it's okay, but you are going to be chasing that customer in many cases. Any questions about this tool here? Great tool. You just definitely have to get there and play with it. Irene's just making a comment. It took me 4 months to get past underwriting for a $100,000 20-year term policy. 62-year-old, blood taken, heart monitor, and interview. Yeah, it's exactly it. So like in the surety, for example, when you look at the products that they have, they've got the term products, but they also have a graded, modified whole life. Okay, so I think, Peggy, you were asking about a modified policy, but if we're looking at something like this, this is where you have a policy that is a quasi-guaranteed issue. A graded death benefit means that they'll receive a portion of the premiums back in year one, and I don't need to go through all the details, but there's modified as well as graded death benefits. So those that have much more of a significant health issue, that's what these policies would be for. Okay, that's for somebody over 40, maximum age 80 on that issuance. So great tool. Just want to make sure that everybody knew it was here. Again, where do we find that? We find that in the product guidelines. Do I have any questions about this? Okay. Great opportunity there for you to learn some of those products and start with the surety products. So when we're looking at the products, again, product guidelines, quotes, if we're going to go to term and UL quote engine, right here, very simple. You have your final expense quote engine as well. I think for our conversation today, let's keep it simple. Just go in, date of birth, very simple. It's going to show you the nearest age, sex, state, face amount of insurance. What is our payment option? There are deals typically when you're looking at an annual payment rather than a monthly. And then we have simplified issue or guaranteed, non-guaranteed term. Let's stop here for a second. Guaranteed doesn't mean that it's guaranteed issue. It means that the term length is guaranteed for that period. Simplified issue is simplified issue. That is going to be non-paramed, non-blood, urine profile, and all the hoops that you're going to have to jump through. Select the term length, whatever term length that we're looking at. And I'm going to select the guaranteed UL as well on when we come back in so you can see that. All carriers and products, you can choose this Remember that depending on the age of the individual, sometimes the more lengthy terms will not be available. And if you're not sure why you're only seeing a limited number of those plans, get back into the product portfolio to look at that, where I was in the product guidelines. So here's some riders, accidental death, waiver of premium, if you should become disabled, return of premium, child rider units, typically when you want to add extra life insurance for the kids that are in there. For all intents and purposes, leave all this stuff blank because that way you'll see the largest selection of the options. Where we typically have problems are going to be in rate class selection. Remember that if you should go down to standard or preferred non-tobacco, the simplified issue products typically don't offer the preferred non-tobacco or preferred best. When you're dealing with simplified issue products, they are typically only going with the lower rate classes. They're charging everybody a little bit more for the convenience factor. The X-ray option is good. Play with that a little bit, but not all carriers participate. What you would do is you would answer questions in that about height, weight, past medical history, and it'll show you what it is that would be approved. It's kind of a lengthy process, so my advice would be assess the overall health of the member and go from there. So view all the quotes. And this is going to show you what came up. Here's the 20 or the 30-year-old options. We are not selling Sagicor. If you sell Sagicor, be aware the commission is very, 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 very low. Okay? Just want to be aware. So I don't even think we're contracted or did our contracting for it. But if you do, just be advised. Assurity, non-med, $350,000, $150,000. I don't know what I put as far as the modal premium, but that's definitely not monthly. And you will see it's going to put the amounts out there for you over on the right. If I want to edit that quote, I can edit the quote details by clicking edit, and then I can go back. So that's my annual. So if I went to monthly because I hit the wrong button, view all the quotes. Okay. So here again, we can see it. This would go right to your e-app once the person understands they want to do it. And you'll go through, answer all the questions, and go through that process. It's fairly straightforward. Really no surprises there. You can get details about the company here. You could always go back to the product information, which I had showed you earlier, which is on the top of the screen in the products. And you can open this up in a different window. And then you can look through those product guidelines once you find one to manage the expectations of the member. Simple enough. No big surprise. Okay? Some other things that you can do in here, we mentioned whole life. We mentioned some other things as well. This guaranteed UL. I'm just going to kind of show you that really quick. I don't want to spend a ton of time on it. But with the guaranteed UL, when you look at this is where you can get somebody a policy that they're not going to outlive. This is where, they might outlive it, but that's if they're going to live over 121 years. So you can see that we were looking at a policy before that was whatever the years that I had, 20 years, and that was $66 a month. This is $99 a month from Principal National Life Insurance Company. It's a universal life guaranteed to age 121, where if I guaranteed that person to age, and I'll zoom in there, 90, then it's only $86 a month. But that's why, remember, it's more money, right? Same face amount guaranteed for a longer period. So it's important that you understand this guarantee is not a guarantee of the policy being issued. It's guaranteed that they pay $100.38 a month, that they will have this policy for whatever Sagicor has it, and I'd have to pull their modified ledger to look at it to see what length of term that's getting me to. Okay? Okay. So I think that it gives us the ability to run the quotes. You could email these quotes, but again, it's much more of a follow-up. It's a little bit more of a process when you're going through it. So in the presentation that I have here, a couple of screens just goes over You want to make sure you're referencing those underwriting requirements. If someone has got all different types of conditions, like Peg has mentioned, she's got someone that's 50 years old, diabetic, high cholesterol, high blood pressure, been in the hospital several times in the past 5 years. You're going to have to do a graded death benefit for that particular individual if they'll take it. So in that scenario, you can go and check the guidelines for that, and that would be the graded death benefit final expense policy. And that's going to be the whole life in that scenario. So why do we want to go to simplified issue? Just because we want to get you guys started. You need to be talking to people. You need to be having that courageous conversation. Get through it. Talk to them. Why do people not like to do parameds? They feel violated. They don't want people touching them and coming into their house or meeting them somewhere and doing blood and swabs and urine and doctor records and motor vehicle checks, RX checks. The placement rates are so much lower because life gets in the way, okay? So do a phone interview. Get to a dollar amount that is get them a good enough dollar amount that gets them in the door. We could always add to it later. People say, oh, it's more expensive. You're paying for the convenience. It's not that much more expensive. Yes, it is. But ask yourself this question. Are you going to get approved at that standard rate, or are you going to be table 4 or table 5, a much higher rate than you're looking at them? So we get through it. Very simple. When you're looking at it, somebody's asking a question. There's this: how significant of a price difference is there between simplified issue and fully underwritten? It's a decent amount. But get the simplified issue one issued first. They could always get another policy later and cancel one of them if they need to. But what is the likelihood of them actually going through underwriting? Slim and none. Difference is a huge percentage. So when you're going through this, you get them the quote, you get all the excuses. So these are all standard excuses we've all heard 120 times, but let's go through them 121. So I don't have anyone to leave it to. This one I love. This is probably my favorite, because when someone says they don't have anyone to leave it to, they don't love anyone, no problem. I get it. Well, if that's the case, you need a critical illness policy. Because if you're that selfish, if you get diagnosed with a condition and you're going to die, remember, we got to be able to say the word die. If that's the case, let me get you a policy so when you get diagnosed, you can go do whatever you want to do with it. It walks them into, I don't love anyone, those of you that know long-term care, walks them into a blended life insurance policy that will give them access to the death benefit for long-term care benefits. That's our Transamerica Trendsetter policy. But what they do is they really walk themselves into it. I already have it through work. Well, then that's good, because they understand there's a value in having life insurance. But has anybody challenged the person and talked to them about how they determine that amount and how much that is, and is it portable? Because a lot of times when I get it through my employer, I can't leave my employer and take my life insurance with me. Or what? I'll wait until I leave the work. So now I've worked there for 20 years. All of a sudden I'm 62 and I'm retiring from the school board. I never got myself any life insurance. It's not portable. Try and buy a life insurance policy to the value that they need at 62 instead of 42, and they will be shocked. I have enough life insurance. Fantastic. That's great. You have life insurance. How did you figure the number? Let me show you how I figure our number, and we could talk a little bit about if you've got the right number. My services are free. I would just run a little quote for you. See, it takes us 5 minutes. Let's figure it out. I've been putting it off. I just want to put it off. I want to think about it. I want to take more time. Now is the time. We already know the tone for today's call. You're never as healthy as you are today and young as you are today. If you get sick between the time that you're thinking about it, you get hit by a bus, this conversation is out the window. Worst call I get is when, we've had it recently. We've had, unfortunately had a couple of agents pass away in the last few years, and having their spouse or someone call and saying, hey, did they have life insurance? And we say, we have no idea, and they did not. That's a problem. even if you start small. People think insurance is expensive, right? And it's not. You can get a small amount of insurance. You don't have to get, $1 million. Get 50,000, get 20,000. Your family will thank you if you get to deliver a check, right? The family will thank you even for 10 or 15,000. Final expenses of 5 or 10,000, very popular these days. I want to shop around, no problem. You've been going all this time. Let me do the shopping for you. I can get you on to join me. I can show you all of the different quotes we have. Well, why aren't we getting this less expensive one? Well, I saw this thing on TV and they said it was only $10 a month. That's because you're not an 18-year-old female that is an Olympian, okay? You are 42 years old, you've got high blood pressure, cholesterol, and you're overweight. So unfortunately, you can't have a policy for $10 a month. Let me show you the differences now. Very basic, very straightforward. Control the conversation. Call it like you see it, because otherwise they're just going to run around. They're going to waste time. They're going to talk to some other agent that's going to bamboozle them with some low price, put them in at a super preferred, and turns out that they're taking high blood pressure, cholesterol, and diabetes medication, or they're on dialysis, and you can't get them anything. Once you're taking the application, we're assuming that application is going through. Did you check the weight charts? Did you check the kick-out conditions? You guys can read through this. What we have to realize that when you're taking the application, we are the eyes and ears of the underwriter. So as the eyes and ears of the underwriter, we're asking them the who, what, where, why, and how on every application. So be prepared that if you're talking to your member and, you're going to have to know their doctor's name, their doctor's address, when they got treatment, what was the treatment for. It's going to be on every application for life insurance. So be aware that they're going to ask those questions. And I don't know isn't a good answer. You're going to have to put something in those spaces. When you're done with the application, please make sure they know what's going to happen. Make sure that they know what they're purchasing, what the carrier is, what the premium and the frequency is, when they're going to be drafted, what are the requirements going to be, are they going to have to fill out any other documents, and what are the time frames. And I don't want anyone to tell me that they don't know, because I just showed you where to find all of it. All of it is located in that guideline. In the product guidelines, you will be able to find everything that you need to do about what's going to happen, how they can pay, who's going to pay, when are these things going to happen. There are no surprises in this. Okay, ton of information today. But I really think that, the basis of what we've talked about, the fundamentals of term, whole life, blended policies, how to assess how much insurance somebody needs, we should have a little bit more of a understanding. Now, I want to kind of say a couple things before I let everybody go, because I'm already about 15 minutes over 13. So here's the big thing. You got to keep it simple. If you're talking, Peg is talking about someone that she was speaking with that had, had some conditions, that had some different things going on. In most cases, you got to keep it simple. If you've got a whole slew of conditions, go to that graded death benefit policy, because they're not going to get anything else, right? So you don't necessarily have to go through this whole life insurance needs calculator. If we ask the questions that I said in the beginning of our meeting today, right? And this is probably the most important one. What if you died tomorrow? What is the biggest concern you have for your family? This is going to answer your question right here. If you died tomorrow, what would keep you up at night? And then that's simple. It's one solve, super easy. I need to make sure that my family has income. Replacing my income if I should die, and my wife's income. I need to make sure my kids are protected. Boom, done. You don't have to jump through hoops. How much is your income? How many years do you want to replace it for? Let's find you a policy. Keep it simple. If you get too complicated, you're going to sell nothing. Okay? Somebody's saying, what about life leads? No. You all have tons of leads in your system. Call everybody for life insurance. We're not purchasing life insurance leads for everyone. If you are wanting to sell life insurance and you want life leads, we are Wyoming. We are the show me state. Where's it, Missouri? I don't know. One of them, Missouri. So you need to go write some life insurance, and then we could discuss that. Everybody's got plenty of leads, plenty of people to talk to, plenty of customers. Start with your customer base. That's the best way to do it. Question coming in, mentioning, really kind of pushing a surety when you're on a join me and showing the other quote. One company may show up more than the other. On the simplified issue products, typically a surety and Sagicor are the only two that come up. And I just think that we have better experience with the surety all the way around. They've been around, they've got good quality ratings, and it works well. And again, if you don't have them on a join me, it's not going to be the end of the world for these sales, but they do have to have buy-in because they will have to sign at some point electronically. And those are all in the application processing. What other questions about basics, needs assessment, going through it, do we want to talk about together as a group? What keeps you up at night? If you should die, what's the biggest concern for you and your family? I'm about to have a baby. Baby's not even born yet. If I died tomorrow, who's taking care of my baby and my wife? Any questions? Comments? Concerns? What is the link to Carrie Levinson quoting? Inside the document, Life Training 101, which is in the drive, it talks about how you can go set up and get that quoting tool. It also has, when you're running the quote, most of the auto declines that you're going to see and how to get that link and go through that. So that's located in the drive under life insurance. Just making sure I got everybody else's questions. Okay. Levinson offers college tuition for all clients purchasing through them as an added bonus, correct? Only through certain policies. So there is I believe it's the SAGE program that they use where someone can get a credit up to, I believe it's $2,500 per year for tuition and things of that nature with only certain colleges. It is an extra selling tool. It is something that you can use to get people more involved. But I mean, we got to start somewhere, so we can get to those conversations right now. What we want to do is we want to get to our book. We want to engage our book of business, talk to them about life insurance. As your trusted advisor, as your agent, I have a responsibility to kind of give you a call, make sure over the summer we're talking about life insurance, protecting your family. Let me ask you one question. If you were going to die tomorrow, what would be the biggest concern in taking care of your family? That's it. That's your pitch. I mean, very straightforward. They really, at that point, they might hang up on you because that is a courageous and challenging question to ask someone, especially someone who hasn't thought about it or doesn't have a plan. All right. Any other questions? So this is step one in the foundation of training. We'll cover more product-specific things over the next few weeks. The best education you can get is spending some time in the Carrie Levinson website, kind of looking through what they've got here, and we can kind of go from there. So without any other questions, I'm going to let everybody go. Thank you for the time today. I really do appreciate it, and have a great day.